Good morning, ladies and gentlemen, and welcome to the Target Healthcare REIT PLC investor presentation. Throughout this recorded presentation, investors will be in listen-only mode. Questions are encouraged. They can be submitted at any time via the Q&A tab that's just situated on the right-hand corner of your screen. Please just simply type in your questions and press send. The company may not be in a position to answer every question it receives during the meeting itself. However, the company can review all questions submitted today and will publish those responses where it's appropriate to do so on the Investor Meet Company platform. And before we begin, as usual, we would just like to submit the following poll. And if you'd give that your kind attention, I'm sure the company would be most grateful. And I would now like to hand you over to the team from Target Healthcare REIT. Kenneth, good morning, sir.
Good morning from a sunny Stirling. It's nice to be in spring, and with the change in lights up here in the north of Scotland, we get a bit more light at night. I'm presenting today with James Mackenzie, who's Head of Investor Relations, and we look forward to talking you through what's been going on over the last 6 months of the life of Target Healthcare REIT, which is just last week it was 12 years old, so it's cool to be able to tell you our story. The next slide is a good summary of the portfolio that we've created over these 12 years. As you can see, there are 94 homes in the portfolio, just under 6,500 beds. We have 61 million of contracted rent. As you know, we have very long leases, and I'll probably cover that a bit more in the next slide as well. The value of the portfolio is just over 900 million, 925 million, valued at 6.22. And the number of sources of income of that 61 million of rental income is 34 different sources of income. When we started, we said we wanted to be highly diversified because we recognized that there was a significant long-term safety of income by being diversified. And as I say, we were founded 12 years ago, and I think about 4 or 5 years ago, probably now, we joined the FTSE 250. And it's a portfolio of considerable quality, modernity, and very compliant with the modern standards of ESG. 99% of the bedrooms have wet rooms. You may ask why that is important. Well, actually, I hope you no longer ask why that is important, because I've been preaching on that from the very beginning. We believe that for a good standard of care and for the sake of human dignity, what we would desire for ourselves, people should be able to have an ensuite wet room as part of their bedroom for their personal care to be attended to in the privacy of their own room, rather than having to share a common bathroom. The portfolio has got great APC ratings. We think it's probably the only portfolio in the commercial real estate listed space where 100% of the buildings are A and B EPC rated. So no further capital expenditure required in the buildings to meet these obligations. And then, as I said a minute or two ago, in relation to the leases have inflation links, 99% of them, with collars and caps, typically around the range of 2 and 4%. So if RPI goes up by 5%, we only get 4%. If it goes only up by 1.5%, we get 2%. And these leases have 0 break clauses, and the average length of the whole portfolio today is 26.1 years. Let me reflect with you about how the last 5 years have progressed for the portfolio. The number of homes has increased by 32, by half, in other words. The number of ensuite wet rooms, well, generally we always buy homes with ensuite wet rooms, but there are still some recalcitrant developers or builders who have felt in the past that wet rooms were less important. So 5 years ago, 96% of our beds had wet rooms, and we're glad to tell you that today it's just under 100% at 99%. And you'll see that 5 years later, our portfolio is more modern, because you'll remember, and we may speak about that a little bit later, you'll remember that we have in fact sold some of our older assets. I'll note that it's always been above net asset value that we have been able to do that. And we have upgraded the homes, partly as a result of selling some of the older ones, and partly by a little bit of capital expenditure, such that the APC ratings have improved significantly from 80%, which was market leading, to 100%. And the number of square meters per resident has also increased. The residents have great public and private space in our homes, and we're delighted for that, having gone up from 47 to 48 square meters. And as the homes are longer in our ownership, they become more mature. We define a mature home as a home that has been open for 3 years. And you'll see that 5 years ago, 75% of the homes had been open for that length of time. And today it's risen to 91%. And alongside that, you'll see that rent cover is very satisfactory at 1.9 times, which is nearly a 30% increase in rent cover. And all of that has worked through to a satisfactory return compared to others who invest in the healthcare property index, as measured by MSCI in the UK. And you'll see, in fact, that the cumulative outperformance is 76% over the last 10 years. The outperformance over the last 2 years is around about the 5% level. And with all of that, Target Healthcare REIT is number 2 in that index over these 10 years. And we're very thankful that that is how it has worked out. I've said in other contexts that I remember 15 years ago, when we started with the unlisted fund that we had, a major property investor saying to me, as we were discussing the need to enter this index for that fund, he said, of course, what really matters in property, Kenneth, is the returns over 5, 10, and 15 years. And I remember acknowledging that at the time, and we're delighted to see that that continues to be a cumulative outperformance and more recent performance, which is satisfactory. But as I say to the team here, if we stay humble about all of that, maybe we'll be all right. So that's my continued desire. Let's turn to the financial performance. The net rental income, as you can see here, has risen a little by 4%. And you'll remember that that you might even expect in terms of the uplift from the rental increases tied to RPI and an additional home that's come into the portfolio. The cost ratio is largely similar to what it was in the previous 6 months, comparative 6 months. And the cost of debt slightly lower because we're holding a little bit less debt. And with the sale of assets, and EPRA earnings have improved a little. And with the increase in the EPRA earnings, we have paid the increased dividend that we announced last August, September, which continues through this year. And that dividend is 107% covered. And with all of that, our EPRA net tangible assets have increased by 2 pence per share, from 110.7p to 112.7p, enabling us to have this accounting total return for the 6 months to December 2024 of 4.5%. And so we're thankful for these 6 months. Let's get on to the earnings summary. You'll see here how the P&L account of the company has changed compared to the 6 months to December 23. A little more income, the 4% more income. The management fee slightly up, a couple of 100,000. The operating expenses slightly up, as you would expect. And a credit loss provision, thankfully, down a little, so that total expenditure is marginally up, and net financing costs slightly down, with a little bit more money from the development funding. And so our adjusted EPRA earnings are up the 3%. The gross to net in terms of the income, just a reminder to you that we have no voids, that the investment manager provides a full service, and it's a pretty efficient model we would submit. We have a couple of bridges to explain how the rent roll has been achieved. You'll see that in June 2024, the end of the last financial year, we had 58.8 million of income. The rent reviews, these are the ones tied to RPI with collars and caps, that generated an additional 800,000 of income. We also completed some developments in the period, which will give us an extra 900,000 of income, and with other little bits of capex, probably with a little bit of capex on solar panels, and perhaps also some of the wet room work, an extra 100,000 of income, giving us a total income of 60.6 million, a 3% increase. Let's go on to the balance sheet side of the company. This is a pretty clean business in terms of there's no intellectual property here. This is hard assets. I remember an investment banker friend of mine in Edinburgh many years ago saying, especially in times of challenge as we're in today, I like to own assets that are I can get my teeth into, that I can go and touch and feel. Well, there's 925 million of touch and feel assets here, and they're all modern and purpose built. At the year end, we also had some cash, some working capital, and some debt, and we'll get into some of that shortly. And you'll see with that increase in the portfolio market value, EPRA and net tangible assets have increased against a pretty lowly levered company with only 22.7% net LTV, and with significant headroom in undrawn debt and longevity in the debt profile as well. And we have a little bridge here also for how the net tangible assets have grown, the property revaluation net figure there of 1.8 million, and you'll see that the EPRA earnings created 3.1 million of cash, and we paid out 2.9 million of dividends. So the net of all of that is just under a 2% increase in net tangible assets. I said I would get on to the debt. We have a very long-term facility with Phoenix. It's at 150 million, and it is fully drawn. There are two maturity dates for it, January 32 and 37, and you'll see the cost of it is just over 3%. We have two facilities that are shorter term, and I'm delighted to say that both of these banks have offered us new facilities at improved margins, and that is something that's under active consideration. The net debt to EBITDA proportion, as you'll see on the right-hand side, over the last 3 years has dropped from 5.9 times to 4.6 times. There's probably not too many businesses where there are such healthy multiples. and our interest costs are well hedged. The bank facilities and Phoenix, all to November 25, and Phoenix through for a further 7 and 12 years. And then we have quite an interesting slide that one of our brokers has suggested would be quite a useful comparison for you all. And this is where Target is positioned relative to its great earnings yield and its debt level. And you'll see that over on the left-hand side of this chart, Target is the highest in that side, and it's also the third lowest debt level. So we have relatively higher earnings and relatively lower gearing. So really stable. We set out to create a long, stable platform for our investors, and that, I submit, is what we've been able to deliver. I'm now going to hand over to James, who's only been with us a few months, but he's enjoying being with us, and he will take you through the portfolio performance.
Morning, everyone. And yes, I'm going to talk to a few slides in relation to the portfolio of the company. And just a reminder that 100% of the properties are let to our tenants. But yes, let's look firstly at how are our operators performing in terms of the underlying resident occupancy. In terms of resident occupancy, as you can see here, the maturity of the homes is improving. Resident occupancy is recovering post-COVID to maturity levels of almost 86% at the end of December 2024. And with a slight drop off, as you can see at the end of the chart, operators have seen what we expect to be a seasonal drop in occupancy in Q4, consistent with the sector. What's also very important in terms of operator performance is rent cover. And as I'll explain in more details later on, as you can see, rent cover has improved to 1.9 times in terms of the rolling last 12-month rent cover for our mature homes. Now, to give you a bit more detail in terms of some of the business models and metrics for the business models of the operators of the portfolio. In terms of mature homes, being homes which have been traded for over 3 years, as you can see, there have been 5 years of fee increases in the homes, which total 45% over the whole period shown. This compares to total RPI inflation of 34% over the period. Private pay has moved across the portfolio from 66% to 78%, evidencing the quality of the assets in the portfolio. And staff costs as a percentage of total fees over the period have fallen from 57% to 54%. And agency costs have also fallen after going through a spike during the COVID years. The result of these operational factors is that rent cover over the period has now grown to 1.9 times. We're not just gathering the assets for the portfolio, but we are refreshing the portfolio, investing in it and generating returns. For long income, you want your portfolio to be modern and fit for purpose. So how has the portfolio changed over the last 5 years? Well, modernity has improved, with 84% now being purpose-built from 2010 onwards. Older homes have been sold, increasing the overall weighted average unexpired lease term, such that over the 5 years, the WALT has only reduced by 3 years. 91% of the portfolio are mature homes, being homes that have traded for over 3 years, and this has increased from 73% in 2020 as a result of our approach of buying brand new homes that take about 3 years to get to maturity. And we now have 99% of the portfolio with ensuite wet rooms. In summary, this is a great quality portfolio as a result of refreshing and improving the assets. I'm now going to talk about how your portfolio compares to peers and the market in general in terms of the physical property. Well, as you can see, you have a significantly more modern portfolio with no homes being built pre the 1990s and no conversions or conversions plus extensions. This is a premium portfolio. And we have a premium portfolio too in terms of the social impact measures, with 99% of our rooms being ensuite wet rooms, enabling our seniors to be cared for with the dignity and respect that we would want to be cared for ourselves. And in terms of some financial metrics, the comparison of this portfolio against listed peers shows that this portfolio has a similar net initial yield, a similar average value per square metre, and a similar average rent per square metre. However, we would submit that there is significant work to be done on poorer quality stock in the UK and significant capital expenditure needed to bring other assets to ESG standards that are appropriate for the modern age. And I'd now like to hand back to Kenneth to talk more generally about the care sector.
And I love to talk about the care sector because it's something I got really interested in nearly 25 years ago. And there are many seniors coming through. Some people might suggest that I'm one of them as well, because in the next 20 years, there is a doubling of the number of over 85s, and on average, about 12% of the over 85s ends up in residential care. The number here on this slide, as you'll see, is 12.9% is actually, as you would expect, not quite as precise as that, but a bunch of us end up in residential care, but only that, 1 in 10, roughly 1 in 8, that kind of number. So great tailwinds for the sector. And with a premium portfolio, there's the opportunity for private pay. And why private pay? Well, then you're not subject to whatever the government does or Mr. Trump does, or whatever the latest challenge to economic viability does, because there is significant net worth in the age group of the over 65s, the people who are coming through to the 85 plus age group over the next 20 years. 6 trillion of net worth. The sector typically sucks up about 24 billion per annum. The whole of senior living, residential care, around about that number. So 40 years of that only uses up about a billion of the net worth. It's something we've been doing quite a lot of work on, and we think that to remain in that private pay space is a really safe place for our operators to be, and therefore for our rents to be stable, and therefore for your dividends to be stable also. There's also a tailwind in the sector in terms of a trend to quality. And we are delighted that that is the case. When I started 15, 16 years ago, about 9% of the beds in the sector had wet rooms. When we launched Target Healthcare REIT, that had risen by 50%. And I remember observing that and commenting on that, if any of you heard me speak 15 years ago. Today, it's about a third of the rooms. So it's doubled from over the life of the REIT, and we're in the vanguard of that. You can be proud of your company in terms of that. It's doubled from the 14%, doubled and a bit, to 34% of the beds have wet rooms. And of course, a little reminder to you that our own portfolio is very much stronger than that. So definite market shift to quality. And then within the portfolio itself, you'll see here the private pay percentage in June 20, partly COVID times, 66%. During COVID, it dropped a bit, but in the 6 months that we're reviewing to December 2024, the percentage of private pay is up to 78%. And our last slide is inviting me to reflect on the sector and on your company. Well, your company works in a sector where the demographics are totally in our favor, and with a strong element of private pay, we're in a really good place because of the net wealth of our seniors. So we don't think, the national insurance increase starts today, doesn't it? And that's a 7% increase. We expect our fees to rise by more than the additional costs that our tenants are expecting. So the tenants will continue to be profitable. The assets are best in class. We've spoken about ESG standards, EPC ratings, future-proofed, no remedial capex concerns. It's evidence that they're best in class by the very increase that I've spoken to you about private pay. The income for our tenants is inflation-linked effectively, and the income for us for sure is inflation-linked and contractual. And it's supported by the underlying performance of the tenants due to the nature of the way they run their homes. And in terms of capital allocation, we've demonstrated our ability to recycle capital and improve the portfolio, with 8% of the portfolio having been disposed of over the last 24 months ahead of the NAV valuation. So in the light of all of that, we continue to consider further opportunities to consider how best we allocate capital for the benefit of our shareholders. And that's, I think, the end of our presentation, and thank you for listening.
Perfect. Kenneth, James, if I may just jump back in there, and thank you very much indeed for your presentation this morning. Ladies and gentlemen, please do continue to submit your questions just by using the Q&A tab that's situated on the right-hand corner of your screen. But just while the team take a few moments to review those questions that have come in already, I'd just like to remind you that a recording of this presentation, along with a copy of the slides and the published Q&A, can all be accessed via your investor dashboards. Guys, you can see there we have received a number of questions throughout your presentation this morning. And thank you to all of those on the call for taking the time to submit their questions. But Kenneth, James, at this point, if I may just hand back to you just to read out those questions and give your responses where it's appropriate to do so. And if I pick up from you at the end, that'd be great. Thank you.
Thank you, and thank you for your questions. Yes, please do keep them coming. The first question we have is, what are the external growth opportunities? Specifically, what yield do you look for in acquisitions, and how would that compare to THRL's marginal cost of debt?
So the sector is one where approximately 100 homes a year are built, and it's probably been slightly less the last year or two. But we as a team have been doing this for 15 years, and broadly that's the number of homes that are built. And the reason why we're moving from the old conversions and the older stock is these homes typically are dropping out and being refurbished into flats or apartments or something, and quite often demolished, and new homes are replacing them. So typically about 200 old homes with 30 beds leave the market, and about 100 new homes with about 60 beds come into the market. So that is the opportunity for further growth. And the question is, what yield would we look for in these acquisitions? Well, the truth is we'd look for as much yield as we reasonably can get, but sustainable rent levels is also really important. because we want to be creating a portfolio that has long-term stable rent covers, which provides the stability of income, which is so important. So as much as we can get, but around about the 6% yield on whatever is a sustainable rental level. And in truth, over the years of building this portfolio, we have lost more opportunities due to us setting a lower rent level. But we believe over the longer term that will stand us in good stead. The next question.
Thank you. Yep. So our next question is, how does the focus on private fee-paying residents impact long-term revenue stability compared to publicly funded care models?
We're actually in the middle of doing quite a significant review of government expenditure. What is the net increase in social care expenditure? There have been lots of comments over the 15 years we've been doing this of the government about to do something on social care expenditure. And we've been really negative about the potential of that happening over these 15 years. We think that it's all important to be in the private fee-paying place so that we're not subject to whatever the government decides to do in terms of funding social care alongside the challenges of the NHS. The bottom line of it all, social care is, we think, really important. But in terms of vote winners, while Theresa May struggled when she announced she was going to do something on it, in fact, generally, it's lower down the priority list, according to some Murray polls that we've seen. So for us, stay in private fee paying. Don't expect the government to significantly increase its funding. In the last 3 months, we've heard about the government and all of its challenges, and the new budget last week, and all the excitement that there is at the moment with tariffs and so on, and the effect that could have on the UK economy. Stay in private pay, a net 6 trillion of net worth in these seniors, and our homes will get a significant proportion of that and be long-term stable compared to the challenges of public pay.
Great, thank you. And our next question is about the growth in the portfolio valuation. So the portfolio valuation increased by 1.8%. How much of this was driven by inflation-linked rental uplift versus capital expenditure?
Almost 100%. Actually, I think if my memory is about 700,000 or something of capital expenditure as well. But like for like, our inflation has risen by well, it'll be by 1%, because we rise by between 2 and 4%. I'm getting my words mixed up, but I think it's mainly inflation plus some developments.
Great, thank you. And then another question about our discount, the current levels of discount, and then corporate activity in the market. So given what's happening at Care REIT, are you able to say anything about your stance on potential corporate actions at Target Healthcare REIT, and are you actively seeking to close the discount?
I think my general comment to that would be that the board and the manager is completely aware of all that's happening in the REIT space and in healthcare REIT space, and actively seeking to look after our shareholders in the best way possible.
Great, thank you. Whilst you're not a care home operator, how sustainable is the long demand for care home spaces? My question is asked in the context of pressure of public funding and the ever-increasing, some would say, eye-watering cost of private provision. The current generation may be able to fund it through equity release, but will the coffers be bare when the next cohort needs this type of care? Will they look at overseas options, e.g. India or Thailand?
So if I answer the first sentence, leave it on, James. If I answer the first sentence, first of all, of that, people want to see their loved ones. We won't be flying to India or Thailand, or the relationships between the two generations are really sad. So there may be a little bit of that, like handfuls, but we don't believe that will be the case. And you're right, we're not a care home operator. But we do believe actually that the demand for the next 30, 40 years is really stable for this. This is end of life care for the residents, and stay in the private fee paying space, and it's really stable. The generation the generation who are aged 20 to 40, but they're at least 50 years away from becoming residents of homes, they have to create wealth too. But the generation from 50 to 100 have significant private wealth. Yes, the cost. There's a question here about, sorry, James, about the cost of debt.
Yeah, so the question is your cost of debt likely to increase for this year?
Yes, within the slide when we spoke about debt, the cost of debt goes up by 10%, to 4.4 if we replace the facilities that we have. And that is all baked into all of our forecasts in terms of seeking to have a progressive dividend.
Great, thank you. And then we have another question about growth. What rate of growth in terms of number of properties are you planning for?
The rate of growth is all dependent to capital availability. The big focus for the fund in recent years has been to evidence post-COVID the stability, and with that great platform that we have, we anticipate that we will be able to continue to grow as capital is available.
Thank you. And then we have a question about the turnover in the number of homes. So interesting that 200 homes with 30 beds drop out and 100 homes with 60 beds are built. This implies no overall growth in the number of beds across the board. Is this actually the case?
Yes, it is actually. And I'll tell you what's happening. The other interesting aspect, so there's residential care for people, and then there is also domiciliary care. So in the early stages of dementia or frailty, typically, and I remember my mother-in-law got this first of all, you get care in your own home, and the number of people who get care in their own home, and especially funded by the government, is actually reducing in number because of the challenges in social care. But anyway, to answer the beds in relation to care homes, you're absolutely right. The numbers are largely the same as they were years ago.
Great, and I think that answers all of the questions that...
Well, thank you for answering questions. Thank you for asking questions, I beg your pardon. And thank you for your interest in the business. And we hope you find that informative. Thank you for the privilege to enable us to invest in this sector and provide better facilities for all our seniors that we love so much. All the best, and thank you very much.
Perfect. Kenneth, James, if I may just jump back in there, thank you very much indeed for being so generous of your time there and addressing all of those questions that came in for investors this morning. And of course, if there are any further questions that do come through, we'll make these available to you immediately after the presentation has ended. But apart from that, Kenneth, James, thank you once again for updating investors this morning. Could I please ask investors not to close this session, as you'll now be automatically redirected for the opportunity to provide your feedback in order that the management team can really better understand your views and expectations. This will only take a few moments to complete, but I'm sure will be greatly valued by the company. On behalf of the management team of Target Healthcare REIT PLC, we would like to thank you for attending today's presentation. That now concludes today's session, so good morning to you all.